What's going on, goats? My name is Raymo, and welcome back to BooKoo Bucks. Today is day 6 of the ICT Speedrun. If you guys don't know what this is me breaking down 275 hours worth of ICT content into 31 days and videos. Day 6, we'll be going over the core content month 4, parts 10 through 14, and bridge builder slash concepts overview. Also, shout out to Lumi Traders for helping me create this roadmap, which is what I am currently using. And without further ado, let's go ahead and break down the day 6 notes. Day 6, core content, month 4, liquidity pools. Liquidity is the open interest of buyers and sellers in the market and can be further defined by those entities at or near specific price levels. We do not always know why the interest would be in the form of buying or selling, and we do not care. We are interested in knowing where their interest may reside in new pending orders, and as a smart money minded trader, we want to sell to the buyers above market price and buy below to the sellers below market price, selling at a premium and buying at a discount. You want to role play by looking at the charts and say, if I were shorting or longing right now, where would my stop loss be? By doing this, you can get a good read of where other traders would have their stop losses. We can use these liquidity pools to find entries alongside of the higher time frame objectives. So I know in one of the previous sections we kind of already go over liquidity, but one thing I do want to point out here is the idea of trying to roleplay as a retail trader. Yes, at the end of the day, we are all retail traders, but we are trying to think and operate like the banks. So if we can put ourselves in the shoes of a typical retail trader, whenever they are placing a position, whether it's a long or short, where are their stop losses? If we can identify where their stop losses are most likely to be, that is going to be the liquidity, or in this case, the liquidity pool we are trying to identify. Run on bullish liquidity pool. Definition: the low that is under the current market price action will typically have trail sell stops under it on long traders, or sell stops for traders who wish to trade a breakout lower in price for a short position. Validation: when the low is violated or price moves below the recent low, the sell stops become market orders to sell at market. This injects sell side liquidity into the market, typically paired with smart money buyers. Entry techniques: when underlying is bullish, before price trades under the recent low, place a buy limit order just below or at the recent low. You are buying the sell stops like a bank trader or any other smart money entity would. Defining risk: the low you are buying under can see a swing of 10 to 20 pips in most cases. A 30 to 50 pip stop is ideal if your entry is under the low and not above it, fearing a missed enter. So whenever you have a low like it's represented in this image right here, there is going to be sell side liquidity resting underneath it. This is going to come in the form of buyers looking to long the market with a stop loss underneath, or traders trying to trade a breakout strategy where they anticipate once price breaks a low, they are simply going to enter a short position, thinking price will continue to fall lower. Either way, it is still a sell position, whether it is a market execution to sell or short, or whether it is in the form of a sell stop in the form of a stop loss. So when price breaks a low, it is injecting a ton of sell orders into the market. And from a bank trading perspective, the banks are going to utilize those sell orders in order for them to fill their buy positions or long orders to push price on higher. And there probably is a more sophisticated way of entering, but to keep it very simple, as he does in this section, ideally you would place a buy limit underneath the low, and then you would have a stop loss about 30 to 50 pips underneath it. Usually, price may only swing 10 to 20 pips underneath it, but to give yourself a bit more cushion and room, 30 to 50 pips is going to be ideal. So if you have a buy limit under the low, once price takes out the sell side liquidity, taps into that liquidity pool, the bank should push on higher, and if price pushes on a tad bit lower to basically accumulate all the buy orders or long orders they want, that 30 to 50 pip stop loss should give you enough wiggle room to see price eventually go in your favor. And here he states profit taken with buy stops rated. So, in order for the banks to close their long positions, in order for them to take profits off of those long positions, they are going to have to sell those positions. The only way they can sell those positions is if they can also have a buy order on the opposite end. You can't buy something without someone selling it to you, and vice versa. So, here, in order for them to take profits, they are going to end up rating the buy stops or taking out the buy sell liquidity, injecting buy orders into the market. So therefore, they can pair those buy orders with their short orders, which is going to be their take profit event, or simply put, taking profits off of these long orders down here. One thing to note is that ICT sometimes uses the candlestick bodies to identify where the liquidity is. In the following example, he uses the fact that price swept underneath the candle's bodies as a rate of sell stops. In this image here, I wanted to point out how sometimes ICT actually just simply marks up the candlestick bodies rather than the wicks. Here we have the candlestick bodies, he draws a line out here, and he sees price gets underneath it with the wicks. So even though typically we see it in the fashion of price taking out the wicks as a rate on stops, in this case he is counting this as a rate on stops. He doesn't really describe exactly when to use one or the other, but I just wanted to point out that sometimes he does use this, and maybe in the future videos he will help us understand exactly when to use one rather than the other. Month 4 liquidity voids. Liquidity void is a range in price delivery where one side of the market liquidity is shown in long one sided ranges or candles. Price typically will want to revisit this range or void of contrarian liquidity. There is no way to tell how long it will take for these voids to fill in, and when we see these, we know smart money is in play. In the example below, this can also be known as a void of buy side liquidity or the absence of buyers. That means the market aggressively moved away from that consolidation, and because it were priced aggressively lower, it was all on sell side liquidity. Very little buying took place in that rundown. The nature of liquidity void is that we will probably see a move back up into it to fill it. Simply put, whenever price moves aggressively in one direction, in this case when price moves downward very aggressively, this means that there was nothing but sellers in this area. There was an absence of buyers, also known as a void of buy side liquidity. If we see this, most likely price will want to come back up into this area to fill it. Keep in mind there is no way to tell how long it will take to fill it, but usually at some point in time it will. And also note that the only way price can do this is if there is a big entity in the market pumping a bunch of sell orders into the market. So therefore, we understand that the only way price can make this hard or an aggressive move is due to smart money being in play. Sometimes price will partially fill a void, but then fully fill it later. So price does not have to do it all in one go. We have a void here. Price comes in, taps a tad bit, pushes lower, comes in a bit more, and pushes on lower. But if you notice, there is still a tad bit more that needs to be filled. Eventually, price comes up and then fully fills it at this point in time. When you see a separation between the two candles where the closures do not align, this is known as a price gap. This is a sign that smart money is in play here, as we can try to enter off of the price gap. So a price gap and a liquidity void are very similar. The biggest difference is that there is going to be a literal gap in the market. Whenever we see this, we can just about treat it as a liquidity void as we anticipate price to fill it, but also we can use it as a sign that the banks are in play, and we can use it as a way of entering. So as you see here, kind of putting multiple things together, price comes up, fills in the liquidity void, and when it does so, it creates this price gap, showing that one, price filled the gap, so it has no reason to stay in this area, but then also seeing that the banks or the smart money is in play by creating this price gap. If we see this, we can use this as a way of entering. Once price comes up and fills it, we could potentially look for shorts to the downside as we see right here. Month 4 ICT fair value gaps, also known as FVG. Fair value gap is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame charts in the same range of price. Price can actually gap to create a literal vacuum of trading, thus posting an actual price gap. So a fair value gap is going to be a 3 candlestick pattern. We're going to work with this first one, the second one, and the third one. If the first wick low does not touch the third wick high, we are going to have a fair value gap. And he doesn't show it here, but it could actually be a literal gap in the market, very similar as we pointed out here. The first candle's low to close offered buy sell liquidity. The third candle open high offered buy sell liquidity. The fair value gaps show where buy sell liquidity was not offered. To try to simplify this even more, if you understand how candlesticks work, price came down all the way down here and then pushed up higher. The only way price can push up higher is if buy orders are being pushed into the market. So when it says the candle's low to close offered buy sell liquidity, it is talking about this wick down here. The low to the close offered buy sell liquidity as price pushed on higher. Then the second candle, price pushed all the way down, obviously showing that there are sellers in the market. Now, in the third candle, we can see that the open to high offered buy side liquidity, meaning this open here to the high offered buy side liquidity. And actually, this down here would be the open. I apologize. This down here to the high offered buy sell liquidity. So there is still this portion that is missing the sell side liquidity, and this basically is going to be that sell side liquidity void or void of sell side liquidity, either or. So if you notice, this does sound very similar to the previous section where we went over liquidity voids. He does state typically confirmed with a liquidity void on the lower time frame charts. So even though on the higher time frame this is a 3 candlestick pattern and it looks very simple, if we go down to a lower time frame, we're going to see more candles. And most likely, there is going to be a liquidity void. As we know, a liquidity void is going to be in the representation of multiple candles, showing a void of buy side liquidity or sell side liquidity. So basically, it's just about the exact same thing. It's just that a fair value gap is going to be a 3 candlestick pattern, most likely on the higher time frame, and most likely on the lower time frame, it is going to be a representation of multiple candlesticks showing a liquidity void. It is important to know if you are studying a specific time frame. The gap occurs on the time frame you are looking at. You can break down further into smaller time frames, but in the smaller time frames, you will probably end up seeing a liquidity void as it will show multiple candles. When we spot a fair value gap, price will likely fill in this gap. When price gives an up move followed by a down move, that movement of price is efficient because both buy side and sell side was offered. Here, ICT briefly went over this, but I thought it was important to note because it does help us decipher which fair value gap we should be using. For example, we have a fair value gap up here that is not marked, and then we have a fair value gap down here that is marked. If you notice, price comes back on up, fills it before pushing on lower, kind of as we expected. But why doesn't price tap into this fair value gap? Well, he basically explains how price pushed up higher before pushing on lower. So it offered the buy side and then the sell side. But once price broke this low, which is the origin of where price offered the buy side before sell side, there isn't any buy side offered after price went down lower. If that doesn't make sense, what I'm trying to say is price gave the buy side and the sell side up until this point. So this is efficient price action. Both are offered. When price pushed on lower, there was no buying over here to the left. So therefore, we focus on this area and we anticipate price to fill this area rather than this area because price is already balanced up until this point. Month 4, Divergence Phantoms. Price has no awareness of indicators, but we can reverse engineer that thought process and use that market efficiency paradigm where we look at how liquidity is used by the banks. There are two types of divergence. Type 1, bearish when you see a higher high, but not seeing a higher high in momentum slash indicator you use. Type 1, bullish when you see a lower low, but not seeing a lower low in momentum slash indicator you use. Type 2 is trend following, also known as hidden divergence. It is when you have a higher low, but the stochastic cycles down and makes a lower low. That is trend following in nature and usually gives us a really good momentum entry for bullish markets. If we are using indicators for divergences, we also need to remember the bank's objectives and targets. We cannot just see a simple divergence and minusly trade. So in this video, I didn't really write too many notes because it really wasn't too important, but ultimately he is just trying to tell us that we can use indicators for divergences to help with the understanding of what price is most likely going to do, but we need to remember what the higher time frame objectives are and where the banks are trying to target. If we don't have this in mind and we simply see a divergence in the markets and we're just buying or selling based off of that solely, most likely it's not going to work. If anything, we can understand that many retail traders view the market this way, and we can get a good idea of where the liquidity lies and maybe use that to our advantage. But once again, if we're just simply looking at divergences, most likely that is not going to work. He then goes on to describe that there are two different types of divergences. Type 1 is when you're looking at a market and it makes a higher high, and then you look at your indicator and it does not make a higher high, but instead it makes a lower high. If you see that, most likely the market you're trading is also not going to continue to move higher, but instead fall lower. Type 2 is trend following, also known as hidden divergence. It is when you have a higher low, so the market you're looking at makes a higher low, but the indicator, in this case is the stochastic maybe, makes a lower low. In this case, you probably would think that price will end up falling lower, but in this case, it actually gives really good momentum entries for bullish markets. Month 4, double bottoms and double tops. Simply talks about how there is liquidity resting above double tops and below double bottoms. Use this understanding to figure out what the banks will do with the higher time frame direction and to determine how far price will go to sweep liquidity above or below these areas. You can measure the move in which the top or bottom was created and double it above or below. What I'm trying to show here is we have the first touch of the double bottom and then we have the second one here. If we measure the move that was created to form this double bottom and then we double it down here, that is usually what it's going to take for price to sweep the liquidity resting underneath it before price pushes on higher. Same thing with a double top. We have price pushing up, pull back, pushing up, and then push on lower. This second push where price created that double top or the second touch, if we go ahead and measure that move and then double it, this is usually what it's going to take for price to sweep out the buy side liquidity before pushing on lower. I think this might be really important because, for example, if you notice price sweeps out the high here, but price does not reverse and go on lower from here. Price actually runs a tad bit higher before pushing on lower. So that is all ICT is showing here. Basically, double the move to get a good idea of where price has to go in order to sweep out that buy side or sell side liquidity before price most likely moves in the opposite direction. Bridge Builder ICT Concepts Overview uses the analogy of a bridge to help grasp how the market moves. A bridge is designed to take you from one destination to another, and sometimes, even though the route is straight, there may be variables such as construction or traffic. The bridge is a representation of where price is at and what the target is. Once you understand that, you can figure out what some of the obstacles or routes that price may take to get there. Understand that price may look familiar to another situation in the past, but it will not be the same. Describes how things like DOM and market profiles are not needed. We can spot orders with our eyes. In this section, ICT is simply trying to help the new traders understand how the markets move through the idea of a bridge, because I can assume that most of us, if not all of us, know what bridges are. So if we understand where price is most likely going to go relative to where price is currently at, we can think of a theoretical bridge and how is price going to get from point A to point B. For example, if we anticipate price to come up into this internal range liquidity to fill this area and price is down here, how is price going to get there? Well, it will have to cross the bridge to get to this point. And then once it gets to this point, where is the next destination? Well, most likely price will make a new low. So therefore, we have another bridge from point A down to point B. And it is very true. Understand that price may look familiar from time to time, but at the same time, it will never be the exact same. He also points out how things like DOM or depth of market and market profiles are not needed. They can be beneficial if you know how to use them correctly, but ultimately, we don't need those things to understand where price is most likely going to go, and most importantly, where the liquidity lies. You could potentially figure out how far price will move based on measuring the swing move. So, very similar as we went over in the previous section, how do we know how far price will reach above a double top? Well, we'll go ahead and measure that second move, multiply it, and put it right above. Then at that point, we have a good projection of where price is most likely going to reach above to sweep up buy sell liquidity. In this case, we're going to do the opposite. We're going to give one standard deviation, or simply put, double it to the downside. And then from here, we have a measured move swing projection. And if you didn't notice, this markup does relate to the previous one, as we anticipate price to push on higher into this orange box before pushing on lower. So this image here is the exact same thing. Once again, we anticipate price to push on lower. Where can we project this move to go to? At the very least, we can potentially look for price to come down here based off of the standard deviation on lower. Also, he is pointing out this fair value gap resting in discount. Price coming back into a fair value gap is repricing to an area of inefficiency and not rebalance. In this section, he does harp on this a tad bit more, but essentially, when you have a fair value gap, when price comes back up into that area, this is going to be considered repricing, and this is not a rebalance. He does later describe exactly what a rebalance is. And again, this image here does still relate to this one up here as well. So back to over here, if we anticipated price to push on lower, we could have potentially caught a sell position or a shorting position here on this repricing into this fair value gap. If we did miss that, there is another fair value gap that price could potentially tap into before we look for shorts. And yes, even if the fair value gap is this small, this is still a valid fair value gap that we can use for potential entries. You can use the breaker block. He does explain how in this case it is okay that the wick goes above because it was NFP, also known as a news event. So here, if we did miss the fair value gap or simply weren't looking at the fair value gap, we had the opportunity to look at the breaker block. Once price broke underneath this low here, this became the breaker block, and we can wait for price to retrace up into it and then short. Once again, he does point out that it is okay that the wick went above it because it is NFP, as we understand that many news events, specifically NFP, are a bit more volatile in nature. You can also use a turtle soup. Simply seeing that buy side was rated, we can then look for shorting opportunities as we anticipate the banks to fill those sell orders with those buy stops. You can use a bearish order block. From here, we have a buy move before price push on lower, so price is simply mitigating an order block as well. A measuring gap is a fair value gap at the halfway point of the entire move. We do not anticipate this gap to be filled, and we can use this gap to help measure where the final destination of the move will potentially be using the one standard deviation. So bear with me as I try to explain these things because he does not go into depth with these specific teachings. I think the main gist of the video was to basically help those new traders understand the idea of how the market moves and trying to relate that with a bridge. But ultimately, here, what he is saying is that this down here is going to be a measuring gap. The reason why this is a measuring gap because it is near the 50% or even below from the origin of the push down to the destination. Again, with the bridge, we have point A down to point B. Why do we anticipate this to be a point B? Well, it goes back to the idea of we anticipated price to come down to the swing projection and then fill this fair value gap. So somewhere in this area is going to be the breakaway gap that we see on a lower time frame. Once again, sorry, the measuring gap. Once again, this will be the measuring gap because from point A to our potential target point B, this gap is at the 50%, the halfway point of the entire move. So when we have a gap in the 50% or midway point, we can identify this as a measuring gap. Now with the measuring gap, we're going to pull our fib from the swing high all the way down to this wick low. And the reason why it's this wick low and not this one or this one is because this is the wick low that is the beginning of the measuring gap. So once again, from the swing high all the way down to the origin of the measuring gap. And then once we have that plotted, we can use the one standard deviation, which is all the way down here, which is going to be the area where we anticipate price to go. I will point out that I feel like the Fibonacci tool is kind of pointless because we already have an idea of where price is most likely going to go, which we already broke down before. So in this case, using the Fibonacci tool and pulling out the one standard deviation doesn't make a whole lot of sense because we didn't need the one standard deviation to figure out where price will go. But either way, that's what he's teaching, using the Fib tool to plot the one standard deviation to figure out where price is most likely going to go. And when we spot a measuring gap, we do not anticipate this gap to be filled. And I think, simply put, since price is relatively close or at the halfway point from its final destination, price is most likely going to just run to that destination rather than fill this area. And again, it's a measuring gap because we can use it to some extent to measure how far price is most likely going to go. We do not anticipate the breakaway gap to get filled. The reason this is a breakaway gap has to do with the very fine details in the wicks. You can see the low broken and price pulls back up before making a new low. In other words, price already attempted to fill the gap but then made a new low. Knowing that the move was a news event as well plays a role. Also claims that this is a balanced price range because it went down, then up, and not repricing. So bear with me again as he doesn't go into much detail, but from what I got with this is that we have price push on higher before pushing on lower, and this creates that gap here. I don't think this is a breakaway gap after price closes down here at this point in time. If you notice, price pulls back on up, sort of fills this area, and then it makes a new low. So we see price makes a low here, makes a new low, and then even a new lower low down here. So seeing that price attempted to pull back Yes, it didn't pull back all the way, but price pulled back and made a new low. I believe in this case, this is why he is considering this as a breakaway gap and not a fair value gap. Again, if price did not make this new low, then probably he would consider this a fair value gap to potentially get filled, but seeing price pull back and then make a new low, breakaway gap. I also think this is considered a balanced price range rather than repricing because this all happens in one move. I do think it would be different if price did close down here and then we had other candlesticks to work from after that. If we do not anticipate the breakaway gap to get filled, we can use the fair value gap to short from. This move is repricing, not rebalancing. Once price makes a new low, then it is considered balance. Also understand how many traders will not be able to short in this scenario. If so, you really wouldn't anticipate price to take out buy side liquidity because there are not traders in shorts moving their trailing stops above highs. So at this first point, if we do not anticipate this breakaway gap to get filled, we can use this one to short from. For the second point, this move is repricing, not rebalancing. The move I'm talking about is this push up here before price pushes on lower. As price is pushing on up to tap into and fill this fair value gap, this is considered repricing. Now, once price pushes on up and then makes a new low, this is considered balance. The reason being is because buy side is offered and then sell side is offered. So those two sides are offered and then price is balanced. So for this third point, this is a tad bit unique because this did happen during a news event such as NFP. If you have been trading for some time, you understand exactly how the market conditions are during these moments. If you are a new trader, basically it is pretty bad. Essentially, you are going to have slippage and it is very hard to catch entries during this time. So ultimately or realistically, there won't be many retail traders shorting at this time. So if you understand that there aren't many retail traders in the markets, price does not have to pull back on up to take out buy side liquidity, also known as buy stops, because there aren't many buy stops in the market. Again, many retail traders won't even be in the market at this time. So with all those confluences we went over, this is a good sign that price is going to continue to fall on lower. That is all I have for day 6 notes. If you guys do want these for yourselves for absolutely free, they'll be available in the link in the bio inside my free WAP. If you guys have any comments, questions, or concerns, please drop them down below. Thank you for watching, and I will catch you in the next one.